Okay, everyone, like I said previously, thanks for joining me here tonight. And it's just a quick overview of Texas multifamily. And we're going to go through a high level real estate that we focus on, why Texas, and in the end, just a quick little overview on types of returns that can be made. And I'd just like to introduce myself, a little bit about me. I grew up and essentially been working on construction sites since I was 5 years old. I had too much energy to be sitting at home, so in school breaks and the weekends, I was on construction sites with my dad. I went to uni like a lot of people and did a mechanical engineering degree. I have 8 years of project management experience, and I've ran teams of anywhere from 5 to 50 people on commercial, industrial, and even mining infrastructure projects. So a wide variety of experience in different projects. In that time, I've managed $150 million worth of CapEx projects. And I'm happy to say that in that time, I haven't gone a dollar over budget. And yeah, I ended up quitting my job in Australia. As you may be able to tell, I've got an Australian accent. And I suppose I was thinking to myself that I'm running all these projects for big companies. Why aren't I running them on, my own projects? And in the end, US real estate is the best market in the world, in my opinion, to do real estate. So why not do it in the best market in the world? So that's what's sort of brought me over to this side of the world. If we can have a quick look at just a really high level and a bird's eye view of, I suppose, the markets we sort of look for, they've definitely got to be greater than an MSA of 100,000 people, because at the end of the day, you want people to be lining up at the door to stay in your property. You want word on the street. You want everyone there because they know that things are changing and it's a great place to live. And with 100,000 people, it makes it that little bit harder, especially if there's competition in terms of other properties in the area doing the same sort of rehabs and value adds that you're doing, right? So essentially, larger than 100,000, we generally look at the major or the larger metros: Dallas, Houston, San Antonio, Austin. And yeah, we look at smaller deals, not smaller deals, but smaller markets, but they still have to be over 100,000. Now, we look at properties that are newer than 1970 and preferably 1980 and newer. The only exemption, I suppose, is for a 1970s deal, we'll look at something that maybe doesn't have flat roofs or it doesn't have steel piping in the ground. And we definitely like to avoid the aluminium wiring. And essentially, if you can get away from those things, because a lot of operators have been here and done that, and they've fixed up those things already and spent the money. If that's already been done, then a 1970s build property is definitely something we look at as well. I was actually having a discussion with a guy the other day, and came around to this. I asked these 3 questions. One that we just went through, right? How many people live in the town, and what year was the building built? And he said less than 100,000, which was his first answer, and then 1970s build. And I was sort of thinking, it's not impossible. Nothing's impossible, but it's putting yourself in a position of having a harder project than maybe what it needs to be, right? All for the sake of just doing a deal. And then I said, "Oh, what are the main industries in the area?" And he said mining. And me having a background of mining, I sort of just thought to myself, I would never put all my eggs in one basket, especially if that basket was a mining basket, because the mining industry fluctuates so quickly that one day it can be spending money on the mine and running projects and everyone's happy with their jobs, and things change very quickly. And then all of a sudden they don't need as many people and there's not as many jobs and it's a lot harder. So, and those fluctuations come, and people don't know when they're going to come, like any market cycle. But mining cycles sometimes don't even line up with market cycles. They make their own cycles sometimes in the mining industry. So I suppose just avoiding such risks, if you can. Of course you can. There's lots of options out there. So not putting yourself in the position of risk when you don't have to. There's a lot of better opportunities out there. So the value at a higher level, we look for properties with the current rents that are 20 or 25% below the market. So essentially, you can get this just from an operator or someone that currently owns the property that, they've owned it for 10, 15 years, and they're happy with the money that it's generating. They're happy, their tenants are happy, and they're not looking to run it at its absolute peak performance. The current occupancy rate can be low as well with that same outlook, with that same operator that's just they're happy with where the positioning of it is. So we look for real estate deals with lots of different things going on. There's lots of different outcomes and different situations that happen in every deal. But to have a property that's 20 or 25% below market occupancy, and it's got rents 20 to 25% below the market as well, we can come in and bring rents and occupancies to that level. And it could be as easy as just bringing in that more attention to detail. It's not about us being better by any means possible. It's about there was an operator that was happy with the results because it was his property or their property. And now we're coming in with investors, and it's our deal with the investors. And we've got to perform. That's what we're there to do. So we're going to run it at as efficient as we can and not let it be below market on anything that we do, on the rents, on the occupancy, and just run it as the best efficiency as possible. So I suppose it's just two different strategies, and I suppose that's where we come in, and it's great for even the people that live there to be able to be a part of that strategy and live in a better environment sometimes, because we add a lot of, I would say, you can add things to the pool and different amenities to what's already there to complement that. So our investment rationale, I suppose, is that there is a dire need in the US right now for more properties to be built. And if you speak to anyone that does development, it's very difficult at the present time in 2024 right now to really get a loan from the bank to do these types of developments. Not to say that it's not happening, but it's just a lot harder than what it used to be. And with that in mind, it just means that building properties is a lot more difficult, and people always need place to live, which multifamily properties is an affordable price point. And for a long time and for forever, people will stay renting because it's just so hard to get into their own real estate, their own property, either for the price point or just the difficulty of getting a loan. So why I like Texas and why we like Texas is there's a lot of different reasons. But if we can just touch on these four here, it is ranked the best state to do business within the US. And, in 2021 alone, 62 companies relocated their headquarters there, right? And Tesla was already there. It's just a recent thing now, but Twitter, which was recently Twitter, and SpaceX are moving their headquarters to Texas. So, to look at that, to look at companies shifting in that way, it just shows that businesses go there because it's easy to do business. It's a business state. And that's what we're doing at the end of the day. Like the apartment complexes we buy, it's a business. So we're in a state that really allows us to do good business and provides us great returns for that. Now, the population of Texas, and these two stats together, the population of Texas is 30 million, which is the second largest in the US, only second to California. And it's the ninth largest economy in the world, not just the US, but the world, right? And when I looked at that, because Australia, when I compare that to Australia has 26 million people. So it's less people in Australia than in Texas. But Australia is 10 times larger than the surface area of Texas. So Texas is this small state. It's the second largest state in the US, but it's in terms of surface area, it's quite small. So it's 10 times smaller than Australia, with a larger population and a better economy, a larger GDP than the whole of Australia, all in that dense little area. So when I thought about that, it was crazy not to take the opportunity to really focus on real estate within Texas. And along with that, it's a landlord-friendly state. Now, you can get probably the last two things, like the population and the economy, the large GDP in California as well, but it just doesn't have that landlord-friendly state, which means that we can really set our rents. And if we do have any issues with tenants, we're able to move tenants on very quickly that don't fit the mold of the community that we're trying to create, potentially within a month. Whereas though in California, they're a year or thereabouts to get somebody out. So if you have to do that to a lot of tenants to really get turnover to fix up the property and make it perform, you've got a longer duration of getting it to where you need it to be to perform. Instead of in Texas, it's a quick turnaround to get operations running. just went one too far. Okay. So on a high level deal focus, the cap rate that we look at is anywhere from 6 to 9%, just that little bit higher than 6% at the moment, just due to the interest rates. And then the asset class that we look at is a B and C property. And that's just where we feel comfortable that we can go in, raise rents, and put a bit of a management play in and get the returns that we need. And at the end of the day, we do look for properties a little bit less than 100 units every now and again, but predominantly the market we're getting at the moment, where we're looking and underwriting deals 100 units and up. We get anything from 200 units to 400 units and everything in between. And I suppose the renovations and the value add, the cosmetic upgrades that we're looking to do in each unit, it does vary. And it could be anything from, it says $5,000 on my slide, but it could be less than that. It could just be $1,000 to anywhere from 25,000, depending on what the unit needs. We did a due diligence just the other week, and you could go into one unit and it had already been upgraded previously, and the tenant has kept it in that form. And then you could go next door and that unit could have been upgraded, but the tenant hasn't looked after it in the same aspect, and it's got a little bit of damage on different things. So then you could walk into another unit and it hasn't been upgraded and needs a lot of attention. So even in that same one complex, you can have different variables of what you're going to spend on each unit. The price range that we're generally underwriting at the moment is anywhere from 60,000 to 100,000 per unit, depending on the market, depending on location. And rents are anywhere, I'd say, between $750 and $1,250, or a little bit more as well, depending on the type of property. Okay, so how we target properties, like we spoke about previously, it's the mismanaged or distressed. And I suppose at this time, distress is starting to become a factor. And it could be no fault of an operator, no fault of their own as an operator, because an operator that took over a property in 2018, 2019 could have done exactly what they said in their business plan, but the market has just outperformed their business plan. And unfortunately, it's definitely unfortunate for them, because they've done exactly what they said they were going to do, but the market just acted in a way that was unpredictable, like we all know. So distressed properties is definitely something that's coming up, and we're getting a few through. And on top of that, location zoning, we touched on the Class B and C neighborhoods. That's where we see a lot of our deal flow at the moment, and that's where we feel comfortable and buy and renovate for much less than building new. Because if you could build it new for the same price, of course, you'd want a new product that's not 40 or 50 years old. You would build it new and have that newer product. So, of course, we're buying and renovating for less than that. And then the value add potential I've spoken about. We pretty much go in, do the capital upgrades, and then we can implement things, even just security. If it's in a C-class neighborhood that may need more security or fencing, and then different types of amenities to really raise the value of the property, even by adding a good laundry service. Every dollar that you make in that laundry service adds more money to the value of the property. Okay, so I've just added this in because I sort of see that a lot of people haven't been shown this, or there's a lot of people that aren't aware of it anyway that I speak to. I speak to a lot of engineers that haven't really looked too much into passively investing in real estate. So I've made this little graph for a lot of them. But if you can look at this graph, and if we can look at the bottom here, it's a 1.8 equity multiple, it's a 2x multiple, and it's a 2.2x multiple. So what that means, I'm just going to stick to this red line, which is the 2x multiple. On $100,000 investment, now, how many people have $100,000 in their IRA or their retirement savings, even money in the bank? $100,000. If they were to invest that this year in 2024, in 5 years' time, that 100,000 in 5 years, 2029, will be 200,000. So you're going to double it. So it's a 2x multiple. 200,000 on 100,000 after 5 years. Now, after another 5 years, that 200,000 turns into 400,000. Another 5 years, that 400,000 turns into 800,000. And then after 20 years, that 800 turns to $1.6 million. Now, that's just nice, easy math. That's why I put the 1.8 and the 2.2, because not all deals are going to be the same. And not every year you're going to get exactly the same equity multiple. It's going to vary, right? So it could be 1.8 one year, 2.2, 2.22. It varies and you can get different results. But I just wanted to outline this to show the growth just on $100,000 over 20 years. You know, if you're someone that's 35 years old, 40 years old, 45 years old, or even older, in 20 years, $100,000 can turn into $1.6 million, right? On a 2x multiple. And this doesn't include if you were to put another $100,000 in after 5 years, and another 100,000 or 50,000 after 10 years, and really start adding more into this. This is just $100,000 year zero right now and leaving it all the way through to 20 years, not adding any more to it. So I think that's, we've seen how quickly the last 4 years have gone. How COVID started 4 years ago, and now we're nearly coming into our 5th year since the start of that. That's already 5 years. Time goes quick. If you just, your IRA or save your retirement accounts, you can't use them anyway, right? So they are just sitting there, and they can be used in this sort of aspect and doubled over every 5 years. So I just wanted to include this slide just to give a little bit of perspective about the potential and what a lot of people are doing. So I've just put my details here, and able to get in contact to me and ask any questions. I'll open it up for some questions now, and we can go through anything that you have. But yeah, there's my details there if you want to reach out.